This is sound test. Okay. Okay, I can see that people are starting to join. Just making a quick sound check if you can hear me and if you can type something on the Google chat and the dashboard. I can see if you can hear me. Okay, apparently sounds fine. So we have 11 people and it's 1 and we have a Fed release. So let's start the live video. So this is the first video of 2019. I do this like once in a blue moon. Now that's when we do this, and if a long time has passed without a live video, please remind me. I can do it anytime you folks wanted. You folks tell me and I schedule one. So I'm scheduling this one because I want to discuss a couple things. In particular, I want to discuss the NDLA plus some questions from you. So let's talk about the NDLA first. And I know that I have new people in the room and it is going to be a new concept. But the NDLA is some kind of neural net that we use in the room to try to predict moves in SPX. In particular, we try to predict a 1% move in 7 calendar days or 5 trading sessions. And I think it has been a successful net, but we haven't trained it since 2017. So it has been more than 1 year without retraining the net. And those are the new numbers that we have right now. The new numbers that we have is the full precision is down to 53%. So it's still, I think it's a decent precision, in particular if we compare it with the null hypothesis, which is 33%. So we are still coming higher than the null hypothesis. However, partial precision is fantastic. Partial precision is almost 82%. And I think that's where the algorithm has behaved really well. The difference between full precision and partial precision is full precision is when the move is 1% and remains 1% or more after 5 sessions. So all of the 5 sessions passed and the move was 1% or more. Partial precision is different. Partial precision is only if the move happened before the 5 sessions, any time from the moment the prediction was issued to 5 sessions. So it's a slightly difference between the two. One lasts all the way until the 5 days, the other one is at any time. So it seems the algorithm is really good at recognizing the points where the moves are going to happen. But the market has not stayed at those levels for 5 sessions anymore. I guess that's the conclusion, in particular during 2008, and that's what we saw. Then the recall for the algorithm is 62%. The recall is the number of correct predictions over the total moves, over the total 1% moves that happen. So recall is 62%, and this is very useful just to evaluate how many false negatives we have. So it seems that in terms of false negatives, there are not that many false negatives in the algorithm. So we don't trade false negatives, no? So recall is not of interest to us, but for those of you that like to use the NDLA as a contrarian indicator, well, you can see that the amount of false negatives is around 38% or 37.7. And finally, during the same period, the naive strategy, what I call the null hypothesis for the NDLA, has a precision of 33%. What does it mean? It means that if you traded this every day, assuming the null hypothesis is assuming that the market will always move 1% up. No, always. Every week it will do that. That assumption had a success rate of 33%, which is in line with historical values that we have seen. That's very in line with the long-term historical value of 30% that we have seen since 2009. So there is still value in the null hypothesis, and the naive strategy still has value, and the NDLA still is superior to the naive for full precision, but it's even better for partial precision. So the discussion here is that even though the full precision is good, I think I'm going to retrain the neural net. I'm going to do a retraining probably until one more year of data I'm going to put. So I'm going to train it until June 2018. So that's, I like to train them with and leave enough space of new data. I don't want to overfit the neural net. That's not the point. The point is I could train it until yesterday, but then I'll be overfitting the whole thing. No? Like, the idea is to see the predicted value. No? And that's kind of the discussion. If you have any questions, please type the questions. I'll answer questions about the NDLA. Just type them on the chat. It takes probably 10 to 15 seconds to see the questions live here. So please type them and I'm going to check them. Let's see. No questions so far. Okay, well, so I keep moving, and just in case, no questions. Okay, so the whole point of this discussion is that I'm going to retrain the algorithm, so probably I'll have a new live NDLA, so I'll have a new NDLA, I don't know, maybe we could call it NDLA 2.0 or something, to retrain, but the neural net, the structure of the net will be the same, it's just I will have more data on it. Moving on. So we are on the midst of earnings seasons, and I got a question. This is a requested question from the room about earning strategies, about what can we do for earnings, and how could earnings be played. So the disclaimer that I always have when we play earnings is earnings are basically casino plays. No, this is it's like you put money on an earnings play, it could work or it could not work. There is no one can predict how the stock will move after earnings. It's impossible. If the company brings good numbers and the stock falls, and the company brings terrible numbers and the stock goes up, and there is no way. It is, to me, it's a coin flip, or even worse than a coin flip. I will imagine more like a roulette type of game. However, we could have some edges playing at least the volatility space, or we could use volatility as an ally for the play. So in this case, I'm going to look at something like Amazon. Now I'm going to give you an example of how I plan an earnings trade for Amazon. So the first thing I do is you can use the Gamma Central tool in the earnings tab, and in that tab you can see what options are predicting for the move. I have it here because I like to type by hand. I like to do things by hand. And you can see that the move for Amazon, which I don't know when it reports, it might be today, tomorrow, but I mean the implied move, the one day move is 6.59%. So options are implying a move. The move could be, big or small. This looks to me like kind of like on the smallish side, and you can see options for all the expirations in Amazon, and you can see that the volatility collapse is not that big. I mean, it's big for Friday, but Friday is a couple of days from now, and there is no point in playing Friday. I mean, there is no, even if volatility collapses nicely for Friday, there is no a lot of raw dollars to extract from there. From next week, the collapse is decent, 15 points of collapse, and it keeps dropping and dropping. Yeah, I could see that the collapse for April is interesting given how far away it is. It's almost 2 points. Or the March collapse is also a nice, interesting collapse here. 4 points of volatility collapse. And so that's the first thing I look. Okay, so now we know now that option dealers are pricing 6.59, 6.6 now, just to run up. And the collapse is decent, not dramatic, but decent. So what can we do with this? We can compare with historical stats, which also the Gamma Central will provide you. So the mean move after earnings has been 5.73. with a standard deviation of 4. What does it mean? Is sometimes it has moved like almost 10% and sometimes it has moved like 1. No, it's kind of like the variation, standard deviation that you have from the mean. And I will say that options are not that overpriced. I am surprised because Amazon usually is a beast and option dealers tend to overprice this dramatically, but options are not that overpriced. Options are pricing 6.6 and it moves 5.7. It's like 1% of overprice, which is like a rounding error. No, in previous earnings iterations, we have seen a gigantic overpricing, but for this one, Amazon is not that overpriced at all. And it's interesting, options look kind of cheap. In fact, it looks so cheap that the probability that the move remains on that range is only 58%. And we have seen with Amazon before like 90s, 80s. So this is almost a coin toss. It seems that in this release, options are so cheap that they are kind of like pricing half and half. Like Amazon could move a little higher or a little lower, but options to me are overpriced. So in this particular example for Amazon, there is no edge to play short volatility. I know some people love to play the volatility collapse, but I don't think that there is enough statistical edge. With 58% probability, options so cheap and so close to the historical move, there is no edge. So forget about trying to do a short volatility play for Amazon. But that doesn't mean we cannot play in some other ways. So if some of you have a directional thesis for Amazon, so you want to bet that Amazon will go up or Amazon will go down, then you could do vertical spreads. And in this case, it's very simple. We can do vertical spreads around the mean move. So for instance, if you think that Amazon will go up, you could do a vertical spread around 5.7% up. You could do that, no? Because it's very likely that it will be within that range. So you could do a vertical call spread 5.7% point up from where it closes. Or if you are you want to play it down, you can do 5.7% down as well. So depending on how you want to play, you can play it like that with a vertical spread, you know? And that will give you, given that the options are cheap, that will be an interesting play. However, the most interesting play is if we could use the trade a little bit, we could sell a vertical spread in the opposite direction to finance this one. And that one will help us collect the volatility collapse. So if we want to sell, I would recommend selling around 6.5 or 7% down. You know, give us some room. Instead of using the mean move, use the implied move. So if you are playing a move up, so sell a vertical call spread about 7 points down, or sell the vertical put spread, sorry, 7% down or a little more. Just give yourself a little room and then buy the call spread 5.7 up. And you should get like a nice discount there. I mean, it's a way to play the directional move. The whole position becomes a risk reversal. Now, it could be a long risk reversal if you're playing up, or a short risk reversal if you're playing down. And even though for this particular case it doesn't make sense at all to do a neutral play, well, if you want to do neutral plays, there are many ways to do neutral plays for earnings. Iron condors, which I dislike, I utterly dislike, I loathe, I hate. I don't know how to say it strong enough. I don't like to do iron condors. Iron condors are terrible risk reward, the worst. The only time where I will consider doing an iron condor will be if the edge will be massive. And what will be a massive edge? If this probability is like 99.9%, I mean something outrageous, something higher than 80%, 85, 89, then I might consider doing an iron condor. Most of the time I prefer to do strangle swaps. And before going into details, I'm going to check if there are questions. You can type questions anytime because I don't want to move too fast. So let me check if there are any questions. Okay, someone hates here iron condors too, very good. The strangle swap. The strangle swap has a very fancy name, where it's the easiest trade of all the trades. The only thing you have to do is you sell and strangle, let's say expiring next Friday, and you buy the same strangle expiring the Friday after that. So you are kind of swapping a short-term strangle for a long-term strangle. And the position is, of course, when I talk about these positions, every position I talk is a simultaneous complex position. It's not that you do it, you open the strangle here and then you buy it. No, in a single trade you do the two things simultaneously. And I use the strangle swap around the implied move, around the 6.6%. I will do the strikes. And that's a good way to collect the collapse of volatility, because the front month collapses more than the back month. So it's a way to do it. If, in particular, if the collapse is hard for Amazon, with this kind of collapse, it makes no sense. You know, the collapse is not that hard. It's 15 and 9. I don't know. It's not even double the collapse between these two. So I will not do it. There is no edge in Amazon. So don't do it for Amazon. I'm just exploring possibilities. You could also do butterflies. Butterflies are actually really good if the collapse in the farm term is really nice. So for instance, like let's say the collapse for 2020 was higher, like it was like 1 or 2 points, then a butterfly here will be perfect, because there is plenty of Vega on far expirations. So we could capture lots of Vega collapse here, but in the case of Amazon, it's almost nothing. It's noise, so no collapse there. But it could be a good way to do it. Or finally, a calendar, no, which is basically a single leg of the swap. A calendar is just basically, instead of doing a full strangle swap, you just sell a call near term, buy the call farm term, or you do it with puts. You sell a put near term, you buy the call farm term. But that is only if you expect that the underlying won't move at all. So that's kind of the place we could do for earnings. But again, what we do depends on the thesis that you have, and also on the edge that volatility is giving. And I did Amazon because I thought that Amazon will bring lots of edge as in the past, but for some reason in these earnings there is no edge. I wonder why. I guess, I don't know, I guess as it gets more expensive, the volatility becomes lower and lower, so option dealers are willing to take a little more risk, and maybe everyone thinks that nothing will happen with Amazon. I have no idea why the edge is so little on the volatility space. Let's see if I have some questions here. No questions? Okay, folks, I know I'm talking too fast, so slow me down and I'll answer any questions. Okay, so now let's move into volatility. In the volatility space, what I am seeing right now in volatility. So I like to look first at the realized variance at different time frames. And in this case, I'm looking at realized variance in the past 20 sessions, which is the past month, past calendar month. And the market has moved about 19%, which is a decent volatility. 19% is like back to historical means, no? Like since 20% used to be the historical mean in the market, but in the last decade, it has dropped so hard that 19% looks a lot now. So this is because we are capturing a lot of the volatility from last year. It's still present here. So 19% is a very decently sized of past volatility, decently sized past volatility. In the past 2 weeks, you notice that volatility has been really low. So you can see the trend. In the past month, 19, but in the past 2 weeks, 13%. 13% is very, very low for realized volatility. Clearly, the market in the last 2 weeks has been calming a lot. The price action has been more subdued, and you can see that calm is returning into the market. I don't know if this is due because positive expectations, or just suddenly there are no traders involved in the market anymore. And for the last week, this is the volatility for the last week, is only 11%. I mean, market has barely moved. 11%, 10%, those kind of values are extremely low. They usually mean no movement in the market. It's like the market hasn't moved at all. So in terms of realized variance, I will say that we are in a period of calm, perhaps related to geopolitical events, perhaps related to the particular Fed decision that we have today. Everyone is in wait and see mode. The market has been just waiting and seeing what is going to happen, but it's interesting that volatility is coming, like realized volatility is coming down so hard. In terms of VIX, as you know, VIX is the predictions of future realized variance for a month. And it's interesting how VIX is lower than the past realized variance. So even though VIX looks a tad high at 18.7, sorry about that, yeah, it's still lower than the past. So expectations of future volatility are actually lower than past realized volatility. This means that volatility players and option dealers are seeing less volatility in the future than it has happened. The only exception is the VIX9D, which is used to be called VXT, the short-term volatility for the next 9 calendar days. So for the next 9 calendar days, it's around 19. It's a little high, but this is pretty much related to the Fed meeting today. So it's a little inflated. We should check this after the Fed meeting, because eventually that VIX90 should coincide with this one here. It should settle around 11.5 or 12. I will expect this short-term volatility drop into these levels. Also, right here, from the top of my head, without using my advanced volatility simulators, I can tell you that I expect VIX to drop around 14 very soon. If not after this release, by the end of this week, if nothing happens, of course, that's the famous last words, no? If nothing happens, VIX should be around 14, 13, or even lower. And I could go into details about that later on. So let's see if I have some questions. Don't be shy, folks. Let me see. Okay, I have some questions. Oh, you want to look at V? That's so good, because I just posted an analysis for V. So yes, let's look at earnings for V. Right here. I have it here. I hope you can see it. It's in this side. So the implied move is 4.28%. So it is a kind of a, it's not implying that much. It looks that it's not implying that much, but it's high compared with historical volatility after earnings for V. You notice that the volatility collapse doesn't look that much. It looks like only 32 points for Friday, and then 10 and 6. But if we look at the historical mean, the historical mean is only 2.53. So there is plenty of edge, like gigantic edge, to play short volatility with this underlying. In fact, the probability that the move will be in this range is almost 79%. So right there, there is a fantastic edge on the trade. And this is posted in the room. You can check it in the room. But my comments are that I will say that if you have a directional view on this stock, you could really use it with a risk reversal. The risk reversal will be fantastic, and because you will get to collect the collapse in volatility, and the position will be cheaper than if you bought it. The options are tremendously overpriced right now. And if you wanted something neutral, we could look at something neutral too, although the volatility collapse is not that big, but the edge is really good. So this is one of the cases where I might make an exception for an iron condor. I might. I'm not completely sure, but yes, there's good edge on short volatility. What else do I have here for you folks? Okay, let's look at my tools. Implied volatility now. So in this area, I don't know if you can see my mouse. I never know you can see the mouse, folks. But here in this area, in the lower right, I have a term structure of SPX options. You can see that the term structure is kind of flat, and you can see a gigantic spike for the end of today. I guess option dealers love to overprice options just before a Fed release. It's a dramatic overprice of options. But you notice that something that is interesting to notice here is that there is inversion of the curve in the very near term. I guess in the first 20 days, you notice that the curve is inverted. And that is really interesting to see the inversion. And my explanation for it, I guess my thesis for this is that this is related to the Fed. I will expect this curve to normalize and go into contango after the Fed meeting. And also something that is worth highlighting is, I think that you cannot see my mouse, but something that is worth highlighting is that the absolute level of the curve in the farm trends like 50 or 100 days or 150 is substantially lower than 20, substantially lower. It's probably around 17, and that's very interesting. I can tell you exactly around what levels it is. It is around here. Yes, it is around 18. Well, not substantially lower, but I mean it's lower than 20, which is a good sign. It seems that expectations of future volatility are not as extreme as they used to be. So I guess in terms of implied volatility, it seems that the situation is normalized and that finally some amount of normality is coming into the market. However, we have seen in the past that any time that option dealers start to lower the prices on options and normalizing the curve, something happens and inverts the curve. It seems to be a constant since 2018, and I guess, I don't know, it's probably political instability or just the regime we are in a regime where calm doesn't last that long. But at least from the expectations that I see right now, I see the expectations are of uncertainty are limited within the first 20 days. So if we can survive, if Western civilization can survive the next 20 calendar days, it looks really good in terms of volatility. Okay, do I have two more questions. The first one from Andrew. Andrew says, what do you make of the difference between the 20-day variance and the very low intraday? Okay, so yes, we see that 20-day variance is 19. However, if we look at the variance center, we can look that the current realized variance is only 8.1. And what can I make of that? I can make of that there is the scenario that is playing is that liquidity is back in the market. So this is the main scenario. So the market clearly has more liquidity than it used to have in the past 20 days. The thing is, with liquidity, it's always the same. And this is a homework for you folks. With liquidity, it's a relative thing. No, liquidity is not an absolute thing. Remember that liquidity is the amount of contracts that can trade at the best price in a period of time. So apparently this amount of contracts is actually increasing. So there is more offers, there are more bids and more offers, and so liquidity is getting higher. But liquidity can get higher because of two things. It can get higher because more participants came back into the market, more liquidity providers are coming back, or it could get higher just because no one is trading. So if no one is trading, volume is so thin, then the previous liquidity looks higher, you know? So what is happening today is an answer. I think the last time I checked, it truly looks like liquidity is coming back. So we have the volumes, the average volume seems to be normalizing. Therefore, my guess right now, without doing a lot of hard number crushing, is that liquidity is coming back. Also, for this week in particular, we only have 3 data points, Monday and Tuesday and today. And we see this before a Fed meeting. We see that before a Fed meeting, everyone stops trading. So the trading volumes thin and liquidity looks higher. So I don't know if it's an effect that is very short term because of the Fed meeting, but we will see. The good thing is after 2 p.m. or probably after the press conference, we'll see if liquidity has actually came back. If we keep seeing these kind of values around 10 or 11, anything lower than 12 for the next couple sessions, then the verdict is that liquidity is back. And I have another question. What is your advice to play the NDLA setup with a huge gamma imbalance at 2,650? Yes, so okay, there are two things. The gamma imbalance, no, there's a tremendous gamma imbalance at 2,650. It seems that for some reason for the past month, that's the strike that has received all open interest. There is very little imbalance north of it, and it has practical consequences. So one of the practical consequences is if the market breaks decisively this area, there is almost nothing to stop it all the way until the next big round number, and the next big round number is 2,700. So I will say it will be a swift move towards 2,700. And look at the NDLA. The NDLA is kind of in this area. Well, not quite in this area, 2006-88. So the best way to play it, as usual, is with a binary option, and with a binary option at that area. So let's look at a binary option for next week. How much is the binary? This is the binary. Let's price the binary for, I don't know, I think it's the 6. I always forget what is the, yeah, it looks like it's the 6. So the binary is 1.85. It's right there at the limit of what I consider a cheap binary. Remember that for me a cheap binary is 1.5. I think 1.5 is my limit. So 185 is a little expensive, but it could be worth the risk if you use like a tight leash on the trade. What I do usually, I might go a little higher. Let's go to 2,700 and see what price do we get. We get 1.5, so probably 2,700 is a little expensive. I won't play it right now because implied volatility is expensive today. The thing is, there are no free lunches because I will wait until the Fed meeting is over, but by that time the market could be at 2,700 already. So I don't know, it's up to you folks. If you want to play it, you could risk a little bit, I guess. I could do a play for 2,700 now, and after the meeting, if nothing happens like half an hour after the release, then I close the position and take the loss, whatever, like 10 cents or 20 cents loss. It could be a good way to play it. There is a question about iron butterflies and when they are preferred in comparison to call and put butterflies. Okay, so I am running a little higher than the half an hour, but I will answer that one as the last question. The short answer is there is no difference. There is no difference in butterflies because there cannot be difference. If you remember, put-call parity means that the price of a call and the price of a put are intrinsically linked. So they are not independent. If I overprice my puts, I am overpricing the calls for the same strike. So when you have a complex position like a butterfly, it should give you the same answers, the 3 variations. You can do a butterfly with all calls, with all puts, or you can do an iron butterfly, which is a combination of a vertical call spread with a vertical put spread centered on the same place. And the 3 of them should give you the same price. In real life, you don't see the same prices. In real life, you see differences in prices for these butterflies, and people think, oh, there must be an advantage. But the answer is not related to that. Those differences in prices arise just because first, butterflies themselves are not that liquid. Now, the market for complex position is not a very liquid market, so you don't see people making markets all the time there. And the other difference is related to liquidity of the legs themselves. And the option dealers, if I am an option dealer, I'll rather sell you an out-of-the-money option than an in-the-money option. And the reason is that in-the-money options are a pain in the neck to hedge. And the higher in the money, the deeper in the money they are, the tougher they are to hedge because they require lots of capital to hedge. Now remember, the higher the delta of an option, the more of the underlying I have to buy or sell short in order to hedge. So there is this interesting dislike of in-the-money options. So if you want to buy an in-the-money option, you have to overpay a little bit. You have to entice me to buy it. But out-of-the-money options, on the other hand, are really good, and I could price you, I can make your market right away without a lot of complaining, no? So out of the money options tend to be a little cheaper than in the money. And with butterflies, you have a combination. You might have a body that is right there at the money, you have one leg that is deep in the money, and you have another leg that is really far out of the money. So when you do that with calls or puts, you get that situation and the price is kind of all mixed up. The thing with the iron butterfly is that all of the options are out of the money, no? When you enter the butterfly. So I will say that for the purposes of trade execution, if you want to enter really easily into a position, well, the iron butterfly is more attractive because all of the legs are out of the money, and with the exception of maybe of the body that may be in the money or at the money. But you get a good price. But the thing is irrelevant, because as soon as the underlying moves, then you start having options that are becoming in the money or out of the money. You know, everything starts happening, and these mispricings start to happen again. So in general terms, I will say that there is no difference, and that's the way I trade. I always do like call flies or put flies. I don't care about iron butterflies anymore. And final thought about this is that some brokers are really terrible at computing margin for this. I mean, some brokers don't realize that you have a butterfly, and they request these obscene margins for the butterfly, and they might take action. They might start liquidating legs, thinking that your position is completely imbalanced. It is crazy. So I'd rather take the normal butterfly, the call and the put, even though I pay 10 cents more for it, just to keep, you know, a debit trade, and I don't worry about margin computations from my broker. Okay, folks, I think that's all that I have for today so far. But if you have any question, I might squeeze one more question. I'll give you a few more minutes. I went a little longer than expected, but I will say that we should do this more frequently. We should do this at least twice a month. I don't know. You let me know how often you want to do these live videos. Okay. Another question is, when is a broken wing butterfly preferred in lieu of a balance? Yes, Andrew, that's correct. Okay, so first, yes, out of the money options in general have better liquidity. Being puts or calls, if anything is out of the money, it has more liquidity because it's easier for me to make markets. But I mean, in something like SPX, which is the underlying that I trade the most, in SPX, the discussion is theoretical because it's fully automated, and you make a bid on whatever option and you'll get a market, you know? But yes, in general, the iron butterfly has a slight advantage. Personally, I don't do them anymore. Coming back to broken wing butterflies, there is no such thing as broken wing butterflies. I mean, once we start going in that direction, we just move into the realm of complex spreads. Now, it's a complex spread where you are doing something. You are selling this, you are buying this. And the way I like to interiorize this is like doing ratio spreads. It's like you're buying a certain number of things and selling a certain number of other things. So you are doing some kind of ratio trade. And when is that preferred? There is no answer, no? Like you do ratio trades, you do complex spreads, based on your thesis. Now, depending on one you want to capture, do you want to capture a skew? Do you want to capture the collapse in volatility? Do you want to capture terminal distribution? So it depends on these things that you want to capture. I don't have a preference for broken wing butterflies or not. In fact, I will call a broken wing butterfly, I will call it a ratio spread. That's what I call it. So once in a blue moon we do ratio spreads. You have been witness that we did a couple in the past, and I might come back to them, but so far there are not many opportunities for those. Okay, that's it, folks. For me, if you have more questions, just send me a message or post the question in the room. I really appreciate you coming and joining me for this live video. As usual, just keep asking questions. I love answering questions in the main room. I have noticed that I have not received that many requests for trade designs in a long time. I guess it either means that you are experts now doing all your trades, but if you have a trade request and you have a thesis that you want something for me to look at, just let me know. I'll do it more than happy for you. And let's see what the Fed has to say in a few minutes. Take care, folks.